Hello value investors, thank you for joining me. Today I want to talk about what's the right age to become an investor. If you're new to the channel, please subscribe now so you can get my next value installment. Also, to know which stocks I own, come over to my marketplace on Seeking Alpha, Deep Value Returns. Find out the stocks I own and why. You can do a free trial and see how it goes. So let's get started. I was reading this book, Templeton Way, and someone emailed me and said, I like your videos and I like the stuff that you do on Seeking Alpha, but it might not be very applicable to me. I'm 65 years old and I don't really want to get started with investing. I like the way I've been doing it and I like dividends. And your style of investing, it's a bit new to me. So the first thing I wanted to talk about is Templeton. So right now in 2020, I think this quote is more applicable than ever. So he talks about bull markets are born on pessimism, grow on skepticism, mature on optimism, and die on euphoria. So right now in 2020, there is no pessimism. I mean, that's right out the window. Skepticism? Doubt it. So we're in that process of it maturing towards total euphoria. Now, there may be a bit of wiggle room there, but for all intents and purposes, I believe that most people will reasonably say that there is no skepticism at this moment in time. Markets are going high, up, and up. So the right time to invest. So I was kind of just going through the backlog of my mind kind of before we started this video. So I looked over and Templeton, he died when he was 95 years old. Obviously got Phil Carre, that was like 95 also, Walter Schloss, approximately that. Irvin Khan, I think he was like around 108 or 110 even. There's this book, Great Minds of Investing, which I strongly recommend. It's basically just pictures and there's an interview there with him. So obviously Charlie Munger, 96. So it's that mindset. I think that Templeton, when he was 90, he kind of got out a 10-year lease on his office. So that's the mindset of investing. So you're not investing for yourself necessarily. Once you get into the mindset that you're investing for the well-being of it could be your spouse, it could be your children, your children's children. So it's the mindset that, okay, 65, thinks I've been doing like this, but there's no reason to think that the runway is stopping, because you can read Steven Pinker, Harari, plenty of case studies showing that people are living demonstrably longer. You get an extra decade ahead, so the runway is just keeps on getting longer and longer. So I believe the right time to get started is right now, and even if you have been investing, there's no reason to in essence up the game. I mean, there's really no difficulty there. So it's not like you're laying bricks, you're just sitting down and having that attitude that, okay, I've been investing XYZ reason and there is a bit of a better way to go about it. So what is the better way? So I've got some videos on that, on how to invest, but I really want to drive home that it's that kind of Howard Marks idea, that it's like amateur tennis, that you're just literally playing amateur tennis. You're just trying to get the ball over the net. You're not trying to go for the ace on each investment or on each serve. So the way to really go about it, you can do it how John Templeton is doing it. There's highly diversified across several geographies. I don't do that, but I can see the validity in that argument. But the way to do the investing is really, just go through the portfolio and say, just be brutally honest. The stocks don't know you own them. There's no passion, there's no romance there. Just, go through and say, okay, for example, let's say I don't have any position in IBM, but you can have a position in IBM and you're like, I've been holding this IBM since 2015 for the last 5 years. Even if I add back all the dividends, I'm not doing anything as much as I should. For example, IBM is a stock I'm quite familiar with, so I can talk about it. And it's a tech stock, and it's probably one of the few tech stocks that has underperformed this late bull market. So I think that the way to go about it, just go through your portfolio and say, okay, these stocks, realistically, I've held them for a while, buy and hold, is not really working that well. You see the biggest amount of absolute capital that Buffett did was when he sold Apple. So he made a position in Apple. I think he made something like 50 billion return on there. So it's like at the end of his, like not at the end, but like towards the back end of his career, he's making the biggest amount of cash coming in. So that speaks about the power of being, of a certain age and still kind of batting above everybody else. B, it talks about him at his prime, because ultimately, if you're bringing that much of capital in, I mean, you got to be doing something right. People say, oh, Buffett has lost his way. Yeah, that is still up for debate, So I'm just trying to say that being a buy and hold investor might not be, in the present day, the best investment strategy. The world is becoming too disruptive. So go through the portfolio and check out the stocks and think to yourself, okay, maybe some of these positions I've held for like 4 or 5 years, I thought X, Y, and Z, it didn't really transpire. The next step is you get a list of 20 companies that you're kind of interested in, you hear the name, kind of you feel that it's worthwhile checking out. You go through those 20 companies and you just sit down and say, okay, my ambition is to get from these 20 companies to the 1 or 2 that are possible. So you got to go from here to here as quickly as possible. You got to get to know, I do not want to invest in this company, as quickly as possible. So the first thing you got to go for is you don't want to go into a position, or you don't want to buy an asset, you don't want to buy a stock that has too much debt, right? Make the game easy, right? Bat the ball over the net. Just align the cards in your favor. Too much debt, don't get involved. Okay? It's not about trying to shoot for the moon in any investment. It's about the little returns over time that add up. That's really the game. Remember that when it comes to investing, it's really about, if you see how Buffett did it, Buffett approximately, with the Berkshire Hathaway performance, is approximately 20% annualized. I know he did before Berkshire, he was doing 30%, but Berkshire vehicle has been doing 20% for approximately 52 years, it could be. So it's really about that little and often. Don't go for positions that are speculative. Go for positions that are solid businesses that fulfill a niche. You want a high quality business. So what is a high quality business? It's a business that's very stable, very predictable. It was doing, let's say, hypothetically, 55% gross margins. It now does 55.5. Next year it does 55.4. So it's very stable. You don't want a business that's quite cyclical, that in 1 year it does 50% gross margins, and next year it does 20% gross margins, because it's very difficult to figure out how that business is going to likely to do in the next 2-3 years. That's the horizon you got to think about. So align the deck in your favor. So go for the balance sheet. That's the first rule. The second thing that's quite important is just look at the peers. Just try and figure out how the peers are doing and compare and say, okay, my closest peer is trading at, let's say, hypothetically, 5 times price of sales. This business is only growing at 4 times price of sales. There might be some upside. That doesn't necessarily mean that there will be, but it's just getting in the right state of mind. Conversely, if you're looking at the investment and you say, okay, I'm already paying 10 times sales, and the peer is trading at, let's say, 5 times sales, and the peer is much bigger than my company, it could be that that small cap has already is fully pricing a lot of optimism. Now, there's no hard and fast rule when it comes to price of sales, because some businesses are less profitable, therefore those sales have less value, therefore it's a lower multiple that you'd be willing to pay. On the other hand, you have certain businesses that trade justifiably at a reasonable multiple, let's say 10 times sales, but they could very well trade at an even higher multiple once they get quote unquote discovered. So it's about having a bit of a common sense approach. Debt, try and get the cards in your favor. Look at the peer groups. The next thing that I think is quite helpful, and I always do this, just look on the SEC filings. Go on sec.gov and just look at the investment risks. Just go through the first 3 or 4. You don't need to read the whole thing. Just read the first 3 or 4 and say, just try and get a grasp, okay? So maybe the management is talking about, okay, that it's a SaaS business, but when you look there, it says that the average contract is only a month long. I mean, yeah, it is a SaaS business. There is an element that is a recurring element, but every month you got to find new customers. So you look at Shopify, this could be in a case like this. So there is a kind of a rolling period, but when the economy contracts, it may or may not cause a lot of its merchants to come away. So just look at the balance sheet, look at the peers, look at the investment risks. So right now you've ticked a lot of boxes, so you've most likely got rid of your at least 10 of your 20 companies. So you're just going through and you're whittling down. So I've got a lot of videos of that already on this channel. The next step that I think is really important, just look at the cash flow statement. So many investors are really afraid of the cash flow statement. They kind of just don't even bother looking at it. It's really, really simple. So the cash flow statement is broken down into 3 parts. There is cash flow from operations. This is the cash that the business, the organic business, brings in. Very simple. Cash flow from operations. Then you got cash flow from investments. That includes your capex. That's the money that's going out to invest for the growth. And then you got the financing part. That's either they are either diluting or repurchasing their shares, or they're taking on debt or repaying debt. So those are the 3 parts: cash flow from operations, cash flow from investments, and financing. You just want to see that the cash flow from operations, that the bulk of that is really either net income, or a portion of it is net income, a portion of it is working capital. You don't want to see a business where mostly north of 60% of the cash flow from operations is stock-based compensation, because that stock-based compensation implies that management is going to be executing their options, and that's going to dilute you as a shareholder. So you just want to see this relatively clean. So I hope you found this video useful. Come over to my marketplace on Seeking Alpha, find out which stocks I own and why. I offer balanced arguments for them, and I hope you stick around and subscribe.